In the name of God, the most merciful, the most beneficent. And this part of this lecture, we will cover under working capital management about marketable securities. The learning outcome will be understanding reasons for holding marketable securities, different types of marketable securities, evaluating the trade-offs among the variables in marketable security selections, including safety, marketability, yield, maturity, and taxability, and also will touch upon risk and return trade-off. This is the overall framework of marketable securities management that we will have to study, and our lectures will cover on this. So we will be discussing about the US Treasury securities, Federal Agency securities, repurchase agreements, that's called repos, bankers acceptance, commercial paper, action rate preferred stock, negotiable certificate of deposits, euro-dollar deposits, and other marketable securities. Marketable securities management concerns low yield, low risk instruments. Why? Because they are actually marketable securities are considered as like near cash equivalent. So anytime they want, they can get back. So it is very short term. Okay. So therefore it is low yield and also low risk instruments, and these are traded on highly active markets, commonly referred to as money market instruments. The money market is the market for short-term investments where companies invest their temporary surplus of cash. Actually, in the working capital management, we discuss about the current assets, which is short-term in nature, and while we do discussing on that, a cash management that we have seen earlier lecture, and now we are talking about cash equivalent, that marketable securities management, which are traded in the short-term money market. Marketable securities are securities that can be easily converted into cash. They are securities that have highly liquid secondary markets on which they can be quickly bought and sold at a reasonable price. They tend to mature in a year or less and can be either debt or equity. The reasons why companies hold marketable securities. So, the companies need for reserve liquidity purpose and controllable outflows of cash purpose, and income generation purpose. So normally what the companies do, they provide source of near cash to cover any working capital imbalances resulting from insufficient cash inflows. For example, if the inventory is not turning into cash through accounts receivable, or accounts receivable collection is delayed, but still they want to meet any short-term obligations. So they need cash. So such kind of things, so they need to maintain some reserve liquidity purpose, any unforeseen cash needs. And similarly, controllable outflows in order to earn interest on funds that are being held for predictable downstream cash outflows, such as interest payments, taxes, dividends, or insurance premiums, etc. They need to pay in time. So for that also they need, but why they are called controllable outflow? Because they will be promptly known schedule. So they can accordingly predict that what has to be, how much interest has to be paid, because the loan amount is there and market rate is there, loan rate is there. So like that, they will be knowing that. In dividends declared, so they know, and taxes they know how to calculate, so that they know how much is tax due to be paid. Similarly, insurance also. And another is income generation, and that also to earn interest on surplus cash. If they have surplus cash, they need to generate that income from that surplus cash. So if the cash is not in immediate use, So they may put in short-term marketable securities and get some income. Economically speaking, the motives of holding cash are near cash. So there are three motives. One is transaction motive and precautionary motive and speculative motive. Transaction motive is for exchange transaction. Money is exchanged for against transaction that address the unsynchronous nature of cash flows. Sufficient or near cash reserves are needed. For example, small purchases, employee compensation, taxes, dividends, etc. need to be paid. So these are all called transaction motive. Precautionary motive is like kind of safety buffer for any unexpected cash needs. Speculative motive is for the investment, taking the advantage of short-term investment by nature of opportunity cost. So by taking the opportunities, see if there is excess cash for short term, they can use it for that. Reasons generally for holding marketable securities, particularly why do we hold that marketable securities? This is for safety and marketability as and when we need, and immediately when we want, it can be liquidated, and there is yield, return is there, and there is a clear maturity so that we can plan it accordingly, and taxability also is there. There are certain marketable securities where we get tax benefit also. And of course, there is a risk and return trade-off that the though there is a risk, but there is a return also. So if the management is quite well planned, so optimal cash balancing and all these things. So if they understand the risk and return trade-off strategically, they can well trade in uh, marketable securities. As we have seen earlier, these are the variables that we need to evaluate while selecting the marketable securities. The first and foremost thing is the safety. Firms tend to look for short-term marketable instruments that offer both safety and some level of return. And marketability. It is the owner's ability to sell the security relatively quickly without a substantial price concession. When there is no market, so they cannot get sold quickly, relatively quickly, as if any other inventory or any other asset that it can be traded through secondary sources. A security with less active secondary market is considered to be less liquid. So therefore, if there is a primary market and it is easily tradable quickly, so it is highly liquid. So that is the one that we need to look for that. And that is where we call as marketability. Yield is related to interest rate of return and or any price appreciation also. Anything that is yielded by rate of return, the interest, or it can be traded in the market and there is a price appreciation. For variable rate securities, the longer the time to maturity, the greater the potential price variation. And also due to interest rate movements. Yield has an inverse relationship with liquidity, meaning the more liquid a security, the lower its yield. In turn, yield has positive relationship to risk. Higher the risk, the higher the expected return. Yield on safe short-term securities tend to be quite low yield because the risk pattern is good, safety is good, so yield is less. But if you are taking more risk, then yield will be better. That is the trade-off that one company management has to look into. And very important point is about the maturity pattern. It refers to the life of the security and represents the date on which the obligation is settled. Whatever that instrument that we have, that will be the maturity date. And for each kind of marketable security instrument, maturity dates may vary. Short-term securities often are chosen based on a maturity date that matches when the firm has forecasted a need for cash. See, normally the cash need under working capital management, cash management, and marketable securities management. In detail, there will be a budget and there will be need on maturity schedule. So on which date that there will be short-term obligations need to be met. So on which date these kind of marketable security maturity date also falling that way. So if that can be arranged that way, it will be more effective. Some securities may be designated for quick liquidity, while others may be earmarked for less immediate use. So it depends on the schedule again. Taxability. It refers to the tax implication of that security. And a firm's effective tax rate will determine the advantage of tax exempt if there is a tax exempt, and that will be calculated as part of the benefit on the return on the interest rate, because normally the interest expenses for the companies are tax deductible, and after tax from taxable investments need to be calculated. The interest earned on all securities except municipal notes and bonds is taxable. So if it is invested on municipal notes and bonds, so there is a tax benefit. So that has to, while we calculate the effective interest rate, that we need to include that effective tax rate also. US Treasury securities. So now we are going to look into details of each kind of securities for in little more details. So US Treasury securities are direct obligations of the US Treasury, and it is backed by the full faith and credit of the US government. It provides a reference point and market indicator for other securities also, because normally US Treasury bill interest rate is taken as the index also. It depends on that. Even from the examination point of view, sometimes they don't give, but they say US Treasury bill rate. So that students should be aware of taking that, the expected rate of return. So it is considered safe investments because they are free of default risk. Because it is backed by the full faith and credit of the US government, it is free of default risk and actively traded on large secondary market and are highly marketable. So treasury bills do not bear interest normally because they are discounted in the market, and based on the they are getting at the maturity the face value. So it is based on the discount and the maturity date. It is traded in the market. So that price affects the rate. Treasury notes bear interest semi-annually, mature within 1 to 10 years. So it has a lot of variable maturity dates available, but they bear interest semi-annually normally. Treasury bonds, similar to treasury notes, but have maturities longer than 10 years also. Very long-term financing can be used. Generally not purchased for a short-term portfolio except when the bond is close to maturity. Even though it is long-term, sometimes their maturity dates are very near in the short term, so that they can be used as a short-term capability of short-term instrument. And next thing is the federal agency securities. They are called even agency securities. Generally not backed by the full faith and credit of the US government, but still considered relatively safe investment with minimum risk of default. And they are interest bearing securities usually offered and redeemed at face value. Typically smaller issues than treasury securities, not quite as marketable but still highly liquid. And limited tax exposure, many are exempt from state or local income taxes but not state franchise taxes. A repurchase agreement can be thought of as a collateralized loan, like secured loan. Actually, the lender provides cash to the borrower in exchange for a security which acts as collateral. At a future date, the borrower repurchases the same security with initial cash received plus accrued interest. So that is the repurchase agreement. Like this is a sale and subsequent repossession of the same security at a future date at a higher price or with accrued interest. So the relationship like that, the the borrower in need of money become a seller that he sells his security and get money from the buyer, and then after at the maturity he pay back with accrued interest or at the higher price or at the price that at that time the market, then he collect back the security. That's the thing. That is the repurchase agreement. That means he subsequently repossess that security. So this is how this thing. So it is called in short repo. Repurchase agreements are a means for dealers in government securities to finance their portfolios. So it is commonly involved US Treasury securities. US Treasury securities offer, and actually it is repurchased at a rate slightly less than the US Treasury securities offer. So the varying maturity starting with overnight repurchase agreements. So it can be various type of maturity arrangement depending on the loan requirement by the borrower who is called as a seller. Generally considered a relatively safe investment because it is of the government underlier. The securities traded are the government underlier, often transferred to a third party to ensure that securities are available for sale if the issuer default. Next item is bankers acceptance. Essentially, they are like time drafts that result from commercial trade financing. It frequently involves international transactions like trade finance transactions. They are drafts drawn by a non-financial firm on deposits at a bank. It involves a letter of credit accepted by a bank, typically implies the banker's acceptance is backed by that bank. Acceptance by the bank is guarantee of payment at maturity. That means the bankers are guaranteeing on behalf of the importer to the exporter. So varying maturities and denominations, it can be 60 days or 90 days or various type of maturities can be there. The payee can thus rely on the creditworthiness of the bank rather than that of the presumably riskier drawer, that the importer. Because they are backed by the prestige of a large bank, these instruments are highly marketable once they have been accepted. Let's see an example. A banker's acceptance. For example, suppose a US company wants to purchase 1000 units of mobiles at an accumulated price of $1 million from a German company. So they send the purchase order. They send the purchase order to the exporter, and the US bankers, they ask their bankers to issue bankers acceptance to the German firm, the exporter. So the bank, US banker, on behalf of this importer, taking whatever the credit, they do the credit analysis, credit sales terms, and collection policy, everything. After that, they confirm that banker's acceptance to the exporter. So based on this acceptance, the exporter shipped the product as per the order to the importer. So when the bill come, the bill of lading is come on due date, the importer pay to the bank. So this is how this is working. Next item is commercial paper, unsecured short-term promissory note kind of loan, and they are usually issued by large companies and negotiable instrument, but typically held to maturity because of a weak secondary market. And it has got high yield than smaller securities because of its low marketability, and maturity is normally ranges from 1 to 270 days. In the US, commercial paper must be registered with the Securities and Exchange Commission before it can have a maturity exceeding 270 days. So otherwise, 1 to 270 days is the norm. It may be interest bearing or discounted, but usually are discounted. These commercial papers are usually discounted payment. Maybe that means no interest, but they are discounted for trading. Generally rated by credit rating agencies like Moody's, Standard and Poor's to help investors assess risk. Because it is being issued by the larger companies, so this kind of credit rating is important for the market understanding. So benefits of commercial paper, you can categorize the benefits to the issuer of this commercial paper and the benefits to the investor on commercial paper. So benefits to the issuer, like it is low interest expenses and access to short term funding, flexibility and liquidity, investor recognition is there because they are credit rating and larger companies issuing and all these things, and ease and low cost of establishment and no collaterals, no need of security arrangement for that because they are unsecured. To the investor, because it has got higher yield, portfolio diversification can be possible and flexibility and liquidity is there. Action rate preferred stock, called as action rate securities or in short form ARS. They are like debt or preferred equity securities that have interest rates that are periodically reset through actions. Like every 7 days or 14 days or 28 or 35 days, like that, they'll be reset through actions. The periodically their interest rates can be reset. And action rate securities are generally structured as bonds with long term maturities, 20 to 30 years long term, or by preferred shares issued by closed end funds. Equity usually purchased by other corporations that invest in short term debt instruments. So the dividend rate is, as we said, that it is regularly, usually every 7 weeks, to keep the price from fluctuating. So as it is fluctuating, so because of that it is reset. So there will be a standard smoothing approach is here. Investors usually have the opportunity to sell the stock if they do not want the adjusted rate unless the action process fails. Supposing if the action process fails, that is a different thing. But usually the investors have that option that if they don't want to accept that the adjusted rate, they can sell it in the market. It is desirable because of the 70% dividend exclusion allowance on the dividend income. There is a 70% dividend exclusion. What is that dividend exclusion? It is a provision by the Internal Revenue Service, that is IRS, that allows corporations to deduct a portion of their dividends received when they calculate the taxable income. So it is avoiding double taxation. So therefore it is desirable. Negotiable certificate of deposits. They are like interest bearing deposits issued by banks or saving and loan institutions, and which can be traded in money markets, generally sold at face value in denominations of 1 million. For some books it says $100,000. Most mature between 1 and 3 months. Some can be for several years. It cannot be withdrawn before maturity without a high penalty. That means if we have to withdraw, then there will be a penalty interest rate can be deducted, or penalty charges can be deducted. It offers fixed and variable interest rates. The certificated deposits often yield a lower return than commercial paper because they are less risky. And negotiable certificate of deposits are traded under the regulation of the Federal Reserve System, not guaranteed by the Federal Insurance Corporation if in excess of $250,000. So if any negotiable CDs exceed, then it cannot be, the insurance coverage will not be there. Therefore, issuing bank should be investigated carefully. So, which bank is issuing? That these kind of information are very important before investing on that. But they are highly marketable if issued by a large established bank. So, common types include Euro dollar, Yankee CDs, and thrift CDs. So, Euro dollar is like Euro certificates of deposits, dollar denominated CDs issued by foreign branches of US banks and foreign banks primarily in London actually. Yankee CDs issued by US branches of foreign banks and thrift CDs issued by savings and loan associations, saving banks and credit unions. So let's understand with more detail about euro dollar deposits. Typically non-negotiable dollar denominated time deposits held by banks outside the US, although not necessarily in Europe, not subject to US banking regulations, may be purchased through most large US banks. Maturities range from overnight to several years. Most are 6 months or less. Other marketable securities. They are like money market mutual funds, which are invested in short term, low risk securities. In addition to paying interest, these funds allow investors to write checks on their balances. Tax exempted issue of state and local governments. So these are also instruments, tax exempted instruments. And there are two common types in the other marketable securities. One is the CP instrument with floating interest rate reset weekly, that is the commercial paper instrument. Another one is the longer term note with a 1 to 2 year maturity. And short term municipal securities have great price stability and better marketability. And municipal securities are even, it has got some tax advantages packages as well. We'll have CMA adapted multiple choice question. Short term unsecured promissory notes issued by large firms are known as, whether it is agency securities or bankers acceptances, commercial paper, repurchase agreement. From the question itself, we are clear that the unsecured promissory notes issued by large firms, not by banks. So they are like, by definition, commercial paper. We understand that they are consist of unsecured short-term promissory notes issued by large companies. But we can also test why A, B, and D are not correct answers, because we are, the question itself says unsecured promissory notes. So agency securities are not unsecured; they are secured. And bankers acceptance, they are also like, they are not coming from large firms; they are from banks, and also they are secured for uh, the exporter, on behalf of the importers. They get the bankers acceptance, and that means the importers bank is more reliable than the importers. They are secured for them in that case. And also bankers acceptance is from bank, not from large firms. And D is repurchase agreement. They are coming, they are actually purchase of security things from the US treasury kind of documents. So they are not unsecured promissory notes. So commercial paper is the right choice for this. Next one. Which one of the following is not a characteristic of a negotiable certificate of deposit? Have a secondary market for investors, are regulated by the Federal Reserve System, are usually sold in denominations of a minimum $100,000, have yields considerably greater than bankers' acceptance and commercial paper. Option D is the right choice, because that statement is wrong for the negotiable certificate of deposit, and we need to ask the question asking that which is not a characteristic of a negotiable certificate deposit. All other options are the characteristics of negotiable certificate of deposit, because they have secondary market for investors and they are regulated by the Federal Reserve System and are usually sold in denominations of $1,000,000 or $100,000, as some books says. So, and negotiable CDs are often yield a lower return than commercial paper because they are less risky. So, but here option D says wrongly that they are considerably greater than bankers' acceptance and commercial paper. Their yield is greater, which is wrong. So the next question, all of the following are valid reasons for a business to hold cash and marketable securities, except all the reasons are okay except one condition. Which one is the one we find? So satisfy compensating balance requirement. We know that it is the one of the category of motivation or motive for holding cash. So A is right for that reason. So we are supposed to find out which is not a valid reason, because the question is asking all reasons are good to hold the cash and marketable security except. So we have to find which is not the characteristics. So B, maintain adequate cash needed for transaction. So this is the transaction motive. And C, meet future needs. This is also we need that cash for future unknown things. Option D says earn maximum returns on investment assets. So that is not the characteristic for holding cash and marketable securities. Thank you. Praise be to God. எல்லா புகழும் இறைவனுக்கே. And let's meet in the next lecture.